Well, welcome everybody. My name's Stephen Miller. I'm joined today by Eric Souders, who's the lead portfolio manager for the Payden Rygel Absolute Return Bond Fund, and Josip Zdrilic, who's the head of credit structuring research within the Securitized team at Payden Rygel. Welcome, gentlemen.
Thank you.
I guess the fixed income universe has sort of been through a lot in the last couple of years. We've had COVID, we've had supply shocks associated with the Russia-Ukraine conflict. And last of all, we've had inflation, which was initially deemed transitory, but had a little bit more inertia in terms of how it played out. And what that's meant is we've had significantly higher bond yields across the curve. I want to ask you both, and maybe I'll start with you, Eric. What does that mean in terms of your positioning for an absolute return bond portfolio? Does it open up the opportunity set a bit? Does it make you sort of think about how you might allocate, where you might allocate, for example, on the yield curve? What are some of the issues that sort of emanate from what we've sort of seen over the last couple of years?
Sure, thanks, Steve. I think there's a lot to unpack there. I'd say first and foremost, you make the right point, which is yields are higher really across the board in fixed income, something that we haven't experienced for the last 3, 4, 5 years. And I think really the opportunity that is unique in this particular environment is higher quality bond yields are much higher relative to where they've been in recent years. So cash, for example, actually pays you something now. So when thinking about constructing a portfolio and where you're putting capital, having some cash now is more comfortable than it would have been in prior years, just given you're paid to actually have cash. And I think that same dynamic resonates into government bonds, high quality investment grade corporates that actually have reasonable yields. And when you think about the result of yields moving higher the last year or two, prices are also lower. And so the bond market not only presents higher running yields, but also lower prices when compared to a couple of years ago.
Right.
So as a result, you have good running yield potential in much higher quality bonds relative to the last few years, plus potential price upside. Now, I think one more point to make would be that credit spreads are still pretty tight. And so when we think about the bifurcation between high quality assets, like I described, cash, government bonds, investment grade corporates, for example, and then lower quality assets or lower rated assets, we think that you're getting more sufficiently compensated to own the higher quality securities at this time, particularly with some of the macroeconomic factors that are on the horizon. So we've been a little bit less constructive about some lower quality areas of the fixed income market, just given you actually are getting paid to own higher quality securities today.
Right, and including, if I've interpreted you correctly, like at the very front part of the yield curve,
right,
with an inverse yield curve,
right,
you're getting that nice pickup, and you really don't have to go down the quality spectrum as you may have had to have done maybe 2, 3, 4, 5 years ago in order to pick up what is at a fairly attractive yield.
Yeah, precisely. Yeah, the reach for yield, so to speak, right?
Yes.
It's almost a reverse reach for yield now, right? You don't have to reach.
Yep.
You don't have to reach down the credit quality spectrum. You don't have to reach out the yield curve. So you can stay a bit more conservative and defensive in the front end. Obviously, the Federal Reserve and central banks control the front end, so there is volatility there. But nevertheless, with our strategy on the absolute return fund at our firm, we're really more focused today on kind of that 0 to 5 year part of the maturity spectrum, and moving more of our capital toward higher quality assets.
Great. Josip, if I can ask you, in the securitized sort of universe, what has the last 2 or 3 years sort of meant for how you view that universe? And I think before you probably launch into that, securitized is quite a nuanced or niche a part of the fixed income universe, at least for Australian-based investors. So before you start talking to that, if you could just give us a little bit of a snapshot for our viewers of what we mean when we talk about securitized fixed income.
Yeah, sure. So the way to address and just to level set the table for everyone to understand what we're talking about when we say securitization in the securitized market. First and foremost, it's a fixed income sector. It offers fixed and floating rate coupons, so you have a good, healthy mix of options with respect to your coupon style. Duration runs from around 1 year to 10 years on the curve, so you have a pretty healthy choice along the yield curve in which you'd like to participate in. The unique aspect about securitization would be that who's paying the bonds back, right? So typically in a corporate security or a government security, there's one obligor you're facing that's responsible for the payment of coupon and interest. In securitization, often it's a collection of obligors, and these obligors get ring-fenced where you're facing a set of obligors that could be consumer-oriented or commercial-oriented. Most often people, when they think about securitization, they think of mortgages, and for good reason. But that is only one of several types of obligors that one can take a risk position in securitization. There are auto loans.
Right.
There are credit card receivables. There are equipment leases that are facing commercial obligors. There's commercial real estate related exposures one can take. And then lastly, there are corporate loans that can get bundled into CLOs that also kind of fall under the umbrella of securitization. And so what it represents is a mix of coupon styles, a range of duration profiles, and then lastly, a capital structure where Eric was saying it's easy pickings today in high quality bonds that offer good benchmark yields and then additional spread. And so within securitization, that's the sweet spot right now as we see it, high quality short duration bonds that you can get good exposure to and great attractive returns.
Right. So, to pick up on a point that Eric made in terms of locating in the front part of the yield curve, that's the sweet spot for securitization at the moment as well.
That's currently how we see it, yes. So in particular, if you think about securitization as a menu board and just simplify it, there's four main food groups that you can choose from. We mentioned mortgages, so that would be residential RMBS, residential mortgages, so RMBS. There's an equivalent in commercial real estate, CMBS. There's another one called ABS. It's a bit of a catch-all. It's non-mortgage related exposure, and this could be again to the consumer or to
auto loans or credit cards or
It's the ABS piece of the menu board that really references off the front part of the curve.
Right.
We're talking the 2-year, the 3-year. And with the curve inversion, this is a really nice place to camp out and pick your yield and spread.
Okay, I guess, if we go to what is the issue du jour, I mean, I don't want to call it the issue du jour because it seems to have been the issue of the last 18 months, ever since the Fed embarked on its tightening campaign, that we've heard the bond market in particular, or all financial markets, be very, very concerned about recession. Now, in some ways, I'm reminded of the story of the boy that cried wolf, that, bond markets or financial markets keep saying recession, recession, it's around the corner, it's around the corner. Yeah. It hasn't happened. Yeah. But I'm also reminded in that famous parable, the wolf showed up at the end. So I want to get your impression, maybe if I go to you first, Eric, and ask, what do you think about the prospects of recession? Do we take heart from the resilience, say, in the labour market that we've seen in the US to date? Or do we sort of regard that as some sort of calm before the storm? Sure. And again, in answering your question, I'd like you to address, if you would, what that might imply again for how you might look at positioning the absolute return portfolio.
Sure. Well, I think interestingly in your analogy, the wolf tends to show up and spend some time with you before you realize he's really there as it pertains to recessions. You won't really know until you know, or until it's several months in. So I think that right now we believe that we're at a bit of a crossroads.
Right.
And we believe that we've got pretty strong signals coming from the labor market. Right, it's strong. Yep. By most measures, it's strong. Now there are some signs of weakness. So in the U.S., for example, we have seen jobless claims pick up. We have seen the average number of hours being worked per week decline. We've seen overtime hours decline. Nominal wages do seem to be decelerating somewhat. Mm-hmm. So there is some signs of softening, but from a very, very strong starting point. And so the labor market, for the most part, is on good footing. And then that will obviously feed into the consumer in the U.S., which represents 70% of GDP. And so those two pieces of the puzzle, very important. The other part of the crossroads is, well, to some degree, everything else, right? Leading economic indicators look troubling, right? The yield curve is very inverted. You've got manufacturing clearly at recessionary levels. You've got the housing market has seemed to have stabilized a bit. Josip can talk about that, but building permits, home sales, things of that nature they're definitely at very low levels relative to what you would expect during kind of an economic expansion. So we think we're at a bit of a crossroads. So how does that translate into positioning for us? We're more defensive today, right? And and as I said, I think that we're getting paid to wait. And I think there's sometimes it pays to be a bit more aggressive, right, with respect to positioning. Coming into this year, we felt like the recession was overpriced in markets. When we felt like the labor market, the consumer in the U.S., and to some degree globally, China reopening, there were some reasons to be reasonably optimistic relative to where the market was pricing recession. So we were more optimistic at the beginning of the year. We're less optimistic today, but to your point, Steve, we understand that these things can take time. And if you look back to prior cycles, 2005, 2006, that time period, it took quite a bit of time, right? There were some early signs. Housing it looked troubling, but that took 18, 24 months. Same thing in 2000 and 2001. The last point I'll make, and then I'll pause, is to just say that when you look at what we describe as coincident indicators, so inflation is a coincident indicator. It's lagging in nature, particularly when it's driven by mainly shelter or labor. Labor tends to also be a lagging indicator. When you look at those, you're usually, on average, 5 to 6 months into the recession once those indicators turn negative.
Right.
Leading indicators today in the U.S. have been negative for 7 months.
Right.
On average, coming into a recession, they're negative for 6 to 7 months. So again, we're coming out of an extraordinary time period. You said it well at the beginning, COVID, a lot of fiscal stimulus. Maybe this time is different, but I think for us as bond investors, where your upside really is just income and maybe a little bit of price, you've got a lot of downside. Right now, it pays to be a bit more patient.
Okay.
And I would just to add on to some of the points Eric made, how that gets expressed in securitization, and to use the analogy, we know there's a wolf out there. We don't know when and how it's going to show up at our door. But what are we trying to avoid? We're trying to avoid refinance risk at this point, given interest rates are putting pressure on balance sheets, whether that's a consumer or a corporation. And we're trying to avoid long risk exposures. And so what that pushes us toward, again, part of the conversation we had earlier here, is shorter duration bonds. We seek those out, and we're seeking the obligor base that's not reliant on a refinancing event. So self-liquidating assets, car loans, great example. It's a fixed rate, and it self-amortizes towards zero.
Yep.
So you can avoid that refi risk, and it's a shorter duration risk exposure.
So it does have some quite important sectoral implications when you're looking at the securitized world. So Eric referenced mortgages in his answer. How are you viewing mortgages in an environment where, to use Eric's phrase, you're less optimistic regarding the prospects for recession than you were perhaps at the start of the year?
So in the U.S., the benefit of the mortgage market in the U.S. is the loan instrument. We have a 30-year fixed rate mortgage. So it's, from the borrower's perspective, it's 30 years when you want it to be, or it's 1 day or 1 month when you want that to be too. So what we have a situation is most of the mortgage market right now has been refinanced in the past. And so you're sitting on a center of mass at a 3% fixed rate coupon. What that means is the incentive to ever refinance is much, much lower today than it ever has been in recent history. And so the duration of risk associated with those borrowers has extended. So that wolf that we were talking about, we don't know when it's coming, but that exposure to that mortgage pool is likely going to remain outstanding if and when a downturn ever comes. And so we prefer to pivot towards shorter duration type instruments. That it's a protective measure.
Okay, we've talked a bit about inflation and growth and the prospects for recession, and I guess the point to make is, insofar as the Fed's behaviour is concerned, they've got some almost a shallow recession baked into their own forecasts. If we look at those forecasts that the Fed issued subsequent to its meeting last week, I guess following on from that though, so inflation growth, the next issue that we then confront is financial stability. And that has some implications too for how you might set portfolios. Is that something that you're thinking about at the moment, Eric? And then I might sort of come back to Josip and talk about some of the particular nuances insofar as it attaches to securitisation markets. But let's talk about financial stability and does it keep you awake at night?
It does. I mean, it does. I think it keeps the Fed awake as well. I think the banking episode in March is a perfect example of financial stability finally showing its face, and maybe that was the wolf that finally showed up. There were some signs last year. The crypto market was under a lot of pressure last year. The housing market for a brief period of time, non-profitable tech. So there were some things that, when the Fed talks about slowing down the economy and things potentially breaking and financial stability, there were some things that happened in 2022 that were certainly consistent with that. But I think that the banking system is a whole different ball of wax, as we would describe it in the U.S. And so, we think that there's a transition going on right now, and that transition has been, it's been in play for multiple months, if not quarters, which is a transition from focus on inflation to growth and financial stability. Last year, it was all about inflation, right? In most of our careers, certainly mine, we've never seen this type of inflation in developed markets. Now, emerging markets, that's a whole other question. But in the developed world, I mean, it's been 30, 40 years in terms of inflation that we've experienced.
Some of us remember that actually, Eric.
Some of us might. You look pretty young though, Steve. But I would say that dynamic last year, it was solely inflation. What's inflation doing? How correlated are asset classes to that inflation? And then now, inflation is showing signs of trending lower across a variety of different metrics, either direct metrics or indirect metrics, things like commodity prices, et cetera. And so we do think that there's this transition going on. It's going to take time in terms of just focus on inflation to growth and financial stability. And the Fed, to your point, they've acknowledged this, right? And they did back off. I mean, when the banking episode occurred in March, I mean, they took pretty fast and pretty significant measures to help stem that financial instability. So as a result, we think that interest rate duration will play more of a role in a portfolio in the next 6 to 12 months than it might have the last year. Obviously, the last 12 to 24 months, duration has not worked out very well at all. But when the market begins to more normalize, and the things that we have focused on generally the last 20 years, which is growth and financial stability, we think interest rate exposure will have a more prominent role, or should have a more prominent role in the portfolio. And so we have been adding interest duration as a result over the last couple of quarters.
Which dovetails with what you said about a recession, optimistic, less optimistic. Now, can I just ask? I mean, the other issue, and I might also get Josip's thoughts on this. The other issue around financial stability is how it relates to liquidity of certain fixed income instruments. In managing an absolute return portfolio, how do you hedge against liquidity events and sometimes the dramatic impact on prices that can have of even high credit quality financial instruments? Are there any specific strategies you can implement within an absolute return portfolio to mitigate the negative consequences of that?
Sure. I think that the last few years have been there's been a lot of opportunity for lessons learned and just thought around these types of questions. I think something Josip said is important as it pertains to constructing a portfolio and liquidity within that, which is trying to identify areas that can hurt you first. And within fixed income, again, you typically don't have a lot of upside. And you have a lot of downside. You're in a poor asymmetric position. And so identifying areas that can go wrong or that can hurt you first is paramount, right? Because when things go poorly, people are trying to exit positions at the same time. Obviously, dealer balance sheets, the banking community aren't able to provide the same liquidity today that they were 15 years ago. And so these things are all connected. So for us, it's making sure that we have, to the best of our ability, identified and solved for things that we can control. So what's in our control? It's areas that we think can go poorly. It's position sizing, right? So making sure that we understand our risk budgeting and position sizing really from the security level to a particular ticker or company or country up into an industry, and then ultimately at the portfolio level, how those things are connected. So position sizing is critical. Diversification. So in an absolute return bond portfolio, we don't have a benchmark. And I think that's a big benefit, particularly in an environment like today, with respect to an absolute return portfolio versus something that is more managed to a traditional benchmark, right? We don't have risks that we have to manage to. We're very flexible. We've got obviously limitations in terms of what we can do, but we've got good latitude around asset class participation, all parts of securitized, corporates, emerging market debt, development government debt. So a lot of opportunity for diversification. And I think also just not reaching for yield.
Right.
When we don't think the time is right, you don't reach, because that extra 20, 30, 50 basis points, when you're looking to exit positions in a difficult time period, the banking episode is a great example. Everyone loved banks coming into the year. We liked banks at Payden. It was the darling of the market, and things went poorly very fast. And I think that led to a lot of the downturn, the exacerbation of that downturn in the banking sector. So I think it's not reaching. A bit of a long answer there, but there's a lot of different pieces that connect to liquidity and portfolio construction.
Can I just maybe sort of examine this point a little further? Are there explicit insurance strategies that you can put within a portfolio? You know, maybe buying deep out of the money puts or on, you know, certain instruments that, you know, it's a little bit of insurance there, or using the CDS market. Are they things that you might avail yourself of?
Absolutely. I'm glad you brought that up. I think that something that we did quite materially for us as a strategy last year was use the CDX market in both the U.S. and in Europe. And so we mainly participate in cash bonds. So we like the portfolio to be primarily comprised of cash bonds. So we don't like to use derivatives to replicate cash bond exposure. We like to do that in cash space. We rely on people like Josip and his team to help us do good credit work on individual bonds. So that's the starting point. But in difficult environments, derivatives can be low cost. You can get them on in significant size, very, very effective, very efficient. So last year, we were able to bring down portfolio duration using derivatives in the first quarter of last year, and then also bring credit risk down significantly once it became pretty clear that the inflation situation was going to get worse. The Ukraine invasion by Russia, that was somewhat of a nail in the coffin in terms of our view around inflation potentially being transitory or abating. It became very clear that wasn't going to happen. So we used credit derivatives to really bring down credit risk in the portfolio. And then in the middle of the year, when we felt like things had overshot, so to speak, and recession was overpriced, we were able to unwind those credit derivatives and then add back that more synthetic exposure. And then, like you said, using things like out-of-the-money options. So out-of-the-money puts on indexes like the S&P 500, for example, where you tend to have very strong correlation between high-yield bond spreads and implied volatility. And so, you know, it is a portfolio or a fund or strategy that does have a fair degree of credit. And so if we can find cheap ways to hedge the portfolio in such a way where that will protect us and dampen some of the drawdown during adverse periods, we absolutely do that.
Right. And Josip, in the securitized space, you know, financial stability, the impact on liquidity, is that something that your team's giving some thought to at the moment?
Yeah, absolutely. So I'll take that in two parts.
Sure.
I'll start with liquidity first, because I think it's a good way to illustrate the collaborative nature at Payden with respect to a sector desk like the Securitized team, or for that matter, other ones that Eric's team interfaces with. I feel we've done a very good job in the past 12 months being in dialogue to understand his team's risk appetite and posture, to understand when's the time to be a liquidity provider to the market and when do we seek to take liquidity from the market. And to be on the right side of the timing of that is very important. And I think we've had some success over the past 12 months, whether that's selling down the capital structure and less favored sectors at the right time. Us letting him and his team know when the market tone is strong, and lining that up with their risk positioning and desire to switch that. And vice versa, when they have capital to deploy, where are the weak pockets that we can take advantage of and be a liquidity provider to the market. We've had some success in the past 12 months, and that's served us pretty well. With respect to the financial stability, I'll just take it through the lens of the consumer. And the only comment I'll make here is we're very mindful of the fact that the financial crisis has provided the securitized market a very good benchmark to say this is what bad looks like. But it's important to realize that history may not repeat itself exactly all the time. It may rhyme. And so the one thing that we feel could present a new wrinkle into the response function of financial instability is simply the fact that the Fed and policymakers back in the day were writing the playbook on how to respond during the crisis. And what COVID showed us, if you were to fast forward in time, they just pulled out that playbook. And so they unleashed a series of financial backstop programs over a very short period of time. And the market knew exactly how to respond. And so it was this simple mentioning of here's what we're going to do had a calming effect. And so we feel this time when there is finally a turn and things start to crack, there will be more accommodation being given to the consumer as opposed to more of a laissez-faire approach of foreclose, evict, and repossess of assets. So that's just something we're being very mindful of in terms of thinking through how things will play out for the parts of the capital structure that we're invested in.
I guess with all of these things, just an observation on my part, I mean, the flip side of having had an aggressive Fed for the last 18 months or so means that in the event of, an accident, be it a recession or a financial stability issue, the Fed now has a lot more room for manoeuvre than it might have had, say, even going into COVID or through COVID, where it had to be a little bit inventive, and it was less clear, less transparent, a bit opaque as to how these things might work. Just one final question, and I'm just interested in your thoughts on this because there are lots of views out on this. I mean, I think one element that we got out of the experience last year was that fabled 60-40 portfolio didn't have a good year. And I want to get your thoughts on, what does this sort of imply for the role of bonds in a portfolio? Is that sort of assumption that bond returns and equity returns are always and everywhere negatively correlated the right way to think about it? And if so, or if not, what does that imply for the nature of bonds in a portfolio? Do we need to be more inventive, more creative, more thoughtful as a multi-asset investor as to the nature of the bond or defensive exposure that we put in a portfolio? I'll go to you first, Eric.
Yeah, I think COVID and then 2022, I think taught several lessons and reminders about things. And I think the importance of having bonds in a portfolio actually is probably as relevant today as it's been in decades. And so I think, and I referenced COVID and last year because we think it's important not to overreact. You've gone through two really once in a lifetime or once in a generation, perhaps, experiences, two of them in the last 3 years, right? And so if you come out of COVID and done analysis around market volatility and how should I then take that information and translate that into a bond portfolio, you wouldn't own anything with credit risk, right? You would just own government bonds and very, very safe assets. And so we think it's important not to overreact and not to oversolve for the last 2 or 3 years. It's important to learn from them. And so again, we think that bonds have probably the best prospects for potential return, particularly versus more risky asset classes like equities today, when going back, a number of years. If you look at things like equity risk premium, very compressed versus where bond yields are, things of that nature, right? So we do think that the traditional 60-40 portfolio could probably be maybe reconditioned a bit, recalibrated a bit to include more multi-asset strategies on the bond side, right? Something like this strategy, which it doesn't work in all environments, right? It's not necessarily the best thing for every specific environment, but an environment like today, where you're probably going into somewhat of a downturn for the global economy. You want to have more latitude around stock selection and just active management. And then you also want to have latitude around interest rate duration in a portfolio and not necessarily be just tethered to a specific benchmark. So the bottom line there, I think, Steve, is that we think bonds should play a more prominent role in portfolios today, despite the experience last year. But on that 40 side of the 60-40 equation, perhaps investors can be a bit more creative around what bonds they're buying.
No, that's interesting, because an absolute return portfolio probably has the same sort of volatility characteristics as your government bond.
Right.
But it gives you a little bit more flexibility in an environment of uncertainty.
Right.
Without giving up anything in terms of a defensive attribute.
Precisely. When you look at our yield, or the running yield of our strategy, which is around 6%, you look at that versus a traditional global bond portfolio, for example, we've got a yield that's in excess of that global bond, more traditional strategy, and then an interest rate duration profile that it's about half.
Right.
So from a yield per unit of risk, it looks pretty good. Pretty good.
And the securitized world, anything in terms of, I know it's sort of a little bit sort of more focused, but taking up Eric's point about the diversification of the defensive component of your portfolio, securitization assets presumably play a reasonably significant role in that.
I think they should. I think they very well could as well. I'll just put it in simple terms. I feel the starting point of any journey is pretty important. So as you sit here today with the high quality type of fixed income securities that we've described, and think about 6 to 8% yields that they can generate for a relatively short duration, you have to look pretty far back in time to see an equal opportunity from an attractive risk-adjusted perspective. So 6 to 8% for investment grade, high quality, reasonable liquidity assets is very attractive. And then if you think a little further out on the credit spectrum, high yield in the neighborhood of 10 to 12% yields, again for relatively short durations, is very attractive as well. More selective, of course, with the high yield opportunity set, but this to us feels like a very interesting time for fixed income and debt investors, which have been starved from yield for a number of years.
So to Eric's point, if you're going to get your 6% yield with a lowish duration characteristic of the whole portfolio, securitization assets, high quality, short duration securitization assets are going to be a very, very, very important component of that.
Yes,
exactly.
Well, thank you, gentlemen. I think that's certainly been illuminating for me, and hopefully illuminating for our viewers. So yes, again, thank you very much.
Cheers. Thank you, Steve.
Thanks for having us.
Thanks for having us.